Hey everyone, welcome back to the channel. If you're watching this right now on April 2nd, 2026, you already know the precious metals market just delivered another wild ride, and silver took the biggest hit. We're talking a straight up 4 to 5% crash in the US session on the COMEX, and I'm going to break down exactly what happened, why it's happening, the fresh data coming in live, and most importantly, what this could mean for silver's direction over the next few days, weeks, and even into the rest of 2026. Stick around, because by the end of this video, you're going to have a clear game plan whether you're a stacker, a trader, or just trying to figure out if this dip is your buying opportunity or a warning sign to stay on the sidelines. Let's start with the numbers, because the action today was insane. As of right around 1:30 p.m. Eastern, the May 2026 COMEX Silver Futures contract, that's the front month SIK6, is trading right around $72 down to 72.31 per ounce. That's down roughly 4.5 to 5.4% on the day. To put that in perspective, it opened the US session near $75.15 to $75.40, spiked up briefly towards $75.98 in early trading, then absolutely sold off hard, hitting a low of $69.61 before a little bit of a dead cat bounce back up into the low 72s. Volume is elevated too. We're looking at over 44,000 contracts traded already, which is pretty heavy for a regular session. Spot silver on the street is sitting around $72.35 to $72.95, depending on who you ask at Kitco or the LBMA fix, also down about 4.9%. Yesterday's close was $76.07, so yeah, this is a real move, not just noise. Now, if you've been following silver this year, you know 2026 has been nothing short of a roller coaster. We saw silver blast to an all-time high above $120, even touching $121 back in late January. Then came those brutal 30 to 37% single-day or multi-day crashes triggered by margin hikes on the COMEX, hawkish Fed signals, and some massive profit-taking after that parabolic run. From those January peaks, silver has already given back around 40% at its worst points, recovered about 18% off the lows earlier in Q1, and now we're watching it give back a chunk of those gains again. So today's drop isn't happening in a vacuum. It's part of this broader corrective phase after an insane bull run fueled by safe haven buying, industrial demand, and a ton of speculative money rotating out of other assets. So what's really driving today's crash? Let's break it down with the fresh catalysts that hit the wires this morning. Number one, and this is the classic headwind for precious metals, a stronger US dollar and rising treasury yields. The dollar index bounced hard today, and 10-year Treasury yields pushed higher after some comments out of the St. Louis Fed about no immediate need for rate cuts, because inflation risks are still in play. Higher yields mean higher opportunity cost for holding non-yielding assets like silver, and a stronger dollar makes it more expensive for foreign buyers. That combo alone is enough to pressure gold and silver, but silver feels it even more because of its dual role as both a monetary metal and an industrial one. But the real spark today came from geopolitics, specifically fresh comments from President Trump on Iran. In a televised address, he laid out a pretty hawkish stance, saying the US would strike Iran extremely hard over the next 2 to 3 weeks. Markets initially priced that as escalating tensions, which sometimes support safe haven metals, but the reaction flipped fast. Gold spiked to nearly 4,796 earlier, then reversed sharply lower, and silver followed with even more violence. Analysts on the wires right now are calling it a risk-off move, where investors are taking profits and rotating out of metals into the dollar and bonds. One quote I saw from an independent trader nailed it: "The optimism from the last couple of days got over-exuberant, and Trump's bellicose tone reminded everyone that inflation from oil and geopolitics could keep the Fed on hold longer." Oil prices also softened a bit after the initial spike, which took some of the inflationary edge off but still left the dollar looking like the cleaner trade. On top of that, we've got technical selling piling in. Silver had been hovering in a recovery phase after bouncing 18% off the 2026 lows, but it ran into heavy resistance around the $75 to $76 zone, which was also sitting right on some key moving averages. Once it broke lower, stop losses triggered, and the bear flag pattern that a lot of chart watchers have been talking about for the last couple of weeks started to resolve to the downside. If you pull up the daily chart right now, you can see that classic bear flag formation. A sharp drop earlier, then a sideways consolidation with lower highs and higher lows, and today's break below the lower trend line is the textbook breakdown. Measured move on that pattern points to another 36% downside from current levels if it really gets going, which would take us toward the $52 area eventually, though that's a longer-term target. Immediate support is sitting at today's low around $69.60, than the $67 to $68 zone that held briefly in late March. Before we get too bearish, though, let's zoom out and talk fundamentals because this is where the silver story still has real teeth. The silver market is in its sixth consecutive annual deficit in 2026. Supply just isn't keeping up, especially with industrial demand exploding from solar panels, electric vehicles, electronics, and all the green energy push. The Silver Institute and major banks have been hammering this home. Even with some substitution happening in solar manufacturing to cut costs, overall demand remains robust, and physical investment demand is actually projected to rise another 20% this year as retail and institutions keep stacking. JP Morgan just updated their 2026 forecast, and they're calling for an average price of $81 per ounce for the full year. That's more than double the 2025 average, and a big upward revision from their earlier base case of around $56. They're pointing to tight supply and strong investor interest as the key drivers. Other banks like Citi have even more aggressive short-term targets in the triple digits if the physical squeeze intensifies. So here's the tension. On one hand, macro headwinds like the dollar, yields, and Fed policy are dominating the short-term tape and causing these violent swings. On the other hand, the structural bull case hasn't gone away. We still have a chronic deficit, central banks and big money are quietly accumulating physical, and any de-escalation in geopolitics could actually help industrial demand recover while safe haven flows stabilize. India just opened mutual fund access to silver, which could bring in fresh retail demand from one of the biggest physical markets. And don't forget about COMEX first notice day coming up mid-month. That's often when the paper versus physical divergence gets exposed and can spark some fireworks if shorts get squeezed. So what could happen next? Let's game out a few realistic scenarios based on the fresh data we're seeing today. Short term, the path of least resistance still looks bearish into the close and maybe into early next week. If silver can't reclaim $74 on a daily close, we could see a retest of $69.60 and potentially a quick flush towards $67 to $68. A break and hold below $68 would confirm the bear flag breakdown and open the door to that bigger measured move toward 52 to 55, though that would likely take several weeks and probably need another macro catalyst like stronger than expected US data or continued dollar strength. Volume and open interest on the futures are telling us speculative longs are getting shaken out, so expect volatility to stay high. On the bullish side, if we get a stabilization around $70 to $72 and any hint of dollar weakness or cooling yields, maybe from softer inflation prints or dovish Fed speak, silver could bounce back towards $75 to $76 pretty fast. A sustained move above $76 would invalidate the bear flag entirely and target $88 to $90 next, which would line up with the recovery highs from earlier this year. Longer term, into the second half of 2026, the fundamentals point higher. JP Morgan's $81 average implies we're still going to see upside volatility, especially if the deficit widens or if investment demand keeps surging. Some more aggressive forecasts even see quarterly averages pushing toward $85 by Q4 if industrial buying from solar and EVs stays sticky. For you as an investor or trader, here's what I'd be watching closely. If you're a physical stacker, today's dip might feel like a gift if you believe in the long-term deficit story. Just dollar cost average in and don't try to catch the falling knife on leverage. For futures or options traders, the risk-reward on the short side looks favorable as long as we're below $74, but keep stops tight because silver can reverse on a dime with one headline. Look at the gold-silver ratio too. It widened to around 65.1 today, which historically flags silver as undervalued relative to gold, so any ratio compression could give silver extra juice on the next leg up. Bottom line, today's 4 to 5% crash is real. It's painful if you're long, but it's also a classic example of macro forces overriding fundamentals in the short run. The US market is pricing in higher for longer rates, a stronger dollar, and some profit-taking after the Iran headlines. But the bigger picture, sixth straight deficit, exploding industrial use, and institutional forecasts still calling for $81 averages, keeps the long-term direction pointed higher. Silver isn't dead, it's just getting shaken out again. We could see more downside pressure over the next few sessions if the dollar stays bid, but any pause in the macro storm could flip this script fast and send us back toward triple digits later this year. What do you think? Is this the buy the dip moment you've been waiting for, or are you waiting for a lower low before jumping in? Drop your price targets and thoughts in the comments below. I read every single one. If you want me to follow up with a live chart update or a deeper dive on how to trade the COMEX first notice day, hit that like button, subscribe, and turn on notifications so you don't miss it. Thanks for watching, stay safe out there, and I'll see you in the next one. Take care.